In this week's news for long-term investors, remarks by President Donald Trump boosted hopes of a major tax cut for corporations. Speaking with aviation industry executives, Mr. Trump called his plan to lower the tax burden on American businesses, quote, "big league," and said it was coming along very well. Remarks released by the White House said the plan would be unveiled in late February or early March. Meanwhile, a new monthly report from the Labor Department said there were a total of 5.5 million job openings at the end of December. For several months, this report has essentially been flat. With new job openings near a record high, this signals that the economy is approaching full employment and the job market is tightening. People are quitting their jobs more often, indicating stronger confidence in finding better opportunities, according to the latest government data. While the quit rate declined slightly in December, it remained near the high last reached a decade ago during the last expansion. Consumer sentiment has returned to normal a decade after the financial crisis of 2008. This data series is a lagging indicator and doesn't tell you much about the future, but it has been useful in the past in spotting periods of irrational exuberance, for example, the tech stock bubble of 2000. Nothing like that is happening now. Consumer sentiment is normal, and investors are less susceptible to overpaying for assets and underestimating their risks. While the promise of a tax cut and a stream of positive economic reports have repeatedly pushed U.S. stock prices past record highs since the election, Mr. Trump is not getting rave reviews from everyone on Wall Street. Fitch Ratings Incorporated, one of just 3 national ratings agencies recognized by the U.S. Securities and Exchange Commission, publicly issued a warning that the Trump administration, quote, represents a risk to international economic conditions and global sovereign credit fundamentals. The Fitch guidance cited the Trump administration's abandonment of the Trans-Pacific Partnership, the renegotiation of the North American Free Trade Agreement, a threat to penalize U.S. companies investing abroad, and accusations of currency manipulation by foreign governments as factors that do not portend an easy period of negotiation ahead or much scope for compromise. To quote the Fitch guidance, U.S. policy predictability has diminished, raising the prospect of sudden, unanticipated changes in U.S. policies with potential global implications. Stock indexes closed for the week by hitting record highs on Thursday and Friday, but the warning from Fitch is a reminder that stocks are volatile. The next new crisis, which could happen at any time, could send some investors to the sidelines, and a correction of 10% or perhaps 20% is possible, particularly if what's perceived as protectionism by the U.S. results in retaliation by foreign trade partners. With fake news and alternative facts flourishing, our weekly reports are not intended as advice, but as a source of prudent analysis about news affecting your wealth over the long run. Please feel free to share our timely weekly reports with your family and friends.